So let's take a look now at this little primer on commodity investing. So this is an interesting reading, and there's a few twists and turns. It may actually be easier if you've already gone through the derivatives material, in particular the material on forward and futures pricing. If not, you can still follow this, but you may want to give it a quick second look after you've gone through that, if you haven't already gone through the forward and futures pricing material seen elsewhere in the curriculum. So let's think about this futures market. So here we're talking about commodities, right? So these commodities are not financial products, right? So that's why we have commodity futures versus financial futures. So these aren't interest rates, they're not bonds or anything like that. These are commodities, right? So it's wheat, it's gold, it's cattle. That leads us to a natural set of participants here. So hedgers, if you look at the cash market, they have a long position. So when we say we have a natural long, okay, that means that they're long in the cash market. The wheat farmer's got wheat in the field, harvest is 25 days away, worried about price uncertainty. Well, if he's long in the cash market, okay, he wants to offset that with a short position in the forward market. In other words, he wants to lock in a price at which to sell today. If you have a baker, someone who needs wheat, well, that means that they have a natural short, so they need to buy wheat, and they want to control their variability in their cost of goods sold. So they would go in and take an offsetting long position in the forward market. So whatever your cash or natural position is, you're going to offset that with an opposite position in the forward or futures market. So those would be the hedgers, and that's what well, I guess the economic reason to have these markets would be because of these natural positions and people that have risk that they want to put off. Okay, well, if you want to put off risk, you can do that in two ways. You can have one natural long and have someone else who has a natural short, and you can exchange contracts between hedgers who have opposite risks. Okay, but if you don't have that, then you've got to bring in a speculator. And a speculator, wheat farmer lives in Kansas, knows a lot about wheat and tractors. A speculator lives in New York, drives a Mercedes, and knows a lot about risk. So these are people that are trying to earn a premium by providing liquidity to this market and having a really good understanding of price risk and that type of thing. There's also going to be arbitrageurs, and these are the people that want to create risk-free profits, okay, from price differences over time or between locations, or from the difference between futures and spot markets and those types of things. And it's sort of this attitude, the arbitrageur thing, that we're going to spend a little bit of time thinking about when we get to natural or normal backwardation in a few minutes, right? So hedgers, those are the natural positions. Speculators, they're taking the other side of the contract if there's not two natural positions that offset each other. So then we bring in speculators, and there's also arbitrageurs who are kind of playing around on top of all that. So storability. So the storability of these commodities is going to be important. It's highly storable if it doesn't degrade over time and the storage cost is relatively low. So gold is storable. It's small, compact. It's size/weight ratio to value, size/weight to value ratio is going to be really low, or value to weight is going to be high. So it doesn't degrade over time, which is why we like gold, I think, and so it's highly storable. If you have cattle, well, cattle aren't particularly storable, right? You can keep them in the pen for a few hours, but then you got to feed them and all that sort of stuff. Or maybe bananas would be another one. Relatively non-storable, because as soon as you get them home from the store, they have those brown spots on them. So the storability of a commodity is going to be important, and we'll talk about storage stuff again in a moment. So there's also renewable versus non-renewable. So renewable is something that can be produced without limit. So you can think wheat, we can grow wheat all the time, and it may require, for those of you who are really green, that we have some sort of crop rotation strategy, those types of things, but nonetheless we can produce wheat infinitely, right? So going forward. So the spot price here is going to be highly influenced by the expected cost of future production. So what is it going to cost to produce wheat? Well, that's going to be a big argument in the pricing function for the price of the commodity, and of course then it's going to transfer into the derivative as well. A non-renewable, that's something that has a finite supply. So this would be, oil would be something that we're not making any more of, or at least not making it very fast, since it takes a couple of million years or something like that. It's kind of ground up dinosaurs or something. Anyway, so it's a finite supply, so the spot price is going to be highly influenced by demand. So demand goes up, well, we're going to pull that out of the ground faster, and if demand goes down, then that's going to change the pricing structure. So renewable versus non-renewable. Convenience yield, all right? This is something I think you need to be familiar with. I've always been a little suspect of this concept, but nonetheless, it's going to be presented here like it is gospel and something that you're going to want to understand. So, before we talk about convenience yield, I want to talk a little bit about forward pricing. Okay? So, the way we would price a basic forward contract, assuming that there was no interim cash flows, which of course with commodities there are not, and that there are no storage costs, is we use something called the cost of carry model, right? So the forward price, okay, which I'm going to abbreviate as F, is going to be equal to the spot price, so that's S, and then we're going to think of this from the short's position, right? So the short, remember the long is agreeing to buy at some point in the future at a price we determine today. That price is what we're trying to calculate. The short is agreeing to sell, right? So this S is the spot price, not short, but spot price. So what price, what does this forward price have to be so that the spot could have no risk associated with this contract? That's not exactly where the cost of carry model comes from, but nonetheless, that's a good intuition builder. Well, let's see. If I'm the short, I've got to have a commodity to sell to you at some price in the future. What is that price? Well, if I bought the commodity today, let's say it was selling for $10, then I could put it under my mattress, assuming storage cost is 0, and then I could deliver it to you in the future, but I'd have my $10 tied up for the whatever period of time the contract covers. Well, let's say then that I borrow the money, so I have to pay interest. So 1 plus R here. Right, and I'm going to say that that's 10% because I can multiply by 1.1. So if it's 10%, and we'll just say this is for a full year, so that would say that the forward price would have to be equal to 11. Right? So the no arbitrage forward price in this case, based on the cost of carry model, is going to be the spot price today of 10 times 1 plus the interest rate adjusted for time, which I'm assuming it's a year, so 10% per year. So gives me a forward price of 11. And the point is, if the price is $10.99, okay, well, then the price is too low, and that's going to create an arbitrage opportunity. If the price is $11 and a penny, then the forward price is too high, and that's going to create an arbitrage opportunity. So $11 in this very simple example where there's no storage cost, there's no convenience yield, we know the interest rate, all that sort of thing. So in this case, the no arbitrage price is $11. All right. So that's the no arbitrage price. And if that is clear, that's great. Okay, I went over that fast, I realize, but this is basically covered in the derivatives readings, right? So the first derivative in the readings in the first reading in the derivatives material, we'll go over that. So anyway, so this is the cost of carry model. Well, now what we could do if we switch to commodities is we could think, okay, well, if they're commodities, if they're cattle, we could say, well, the forward price is going to be equal to the spot price times 1 plus R, right? So, whatever a cow costs, I guess, is going to be the spot price times 1 plus R. But if I'm going to buy a cow today, I'm going to borrow the money, okay, buy a cow today, carry it to the maturity or the expiry of the forward contract, then I'm going to have to pay to have somebody take care of that cow in the interim, right? So that's going to be storage cost. So I'm just going to add in some variable U here, right? It's going to be some number of dollars. I'm not going to specify it as percent. So if that ends up being, $20, this is $100, and this is 1.1, then the forward price is going to end up being $130. Does that make sense? So that would say, look, you've got the cost of the asset today, the financing cost, and the storage cost. We all good with that? Now, what is convenience yield? Okay? Convenience yield, in my cynical moments, I think convenience yield is something we plug into these equations to make our models work. But the idea is this. Look, if you hold a commodity, right? So you're the short, you're going to buy the commodity, you're going to keep it in the warehouse. Well, what happens if the world spins out of control and the value of your commodity spikes during the period in which you're holding it, right? Or it's a post-apocalyptic scenario where you enter into the contract, you're the short, you buy whatever it is, and before the expiration of the contract, the whole world melts down, and then you could just get a gun and never deliver, something like that. So think about this. If we're looking at time here, if this is the spot price when we enter into it, so this is time 0 going out to time 10. So the spot price here is whatever it happens to be, $10. If we're rocking along, at $10-ish for the spot price, and then something happens and it goes like this, and then it comes back down. and we observe that over the period of our contract, right? Well, if we own the asset, we bought it here, we would have the option to sell it here and then buy it back down here. Now, I realize that's a pretty fantastic story, but you know, if you buy at 10, you sell at 15, and then you buy it back at 10, you've made a handy profit on that, right? The point is that this scenario, or the post-apocalyptic scenario, or something else, okay, leads us to this fact. Okay, there's some benefit from holding a physical commodity versus just having long exposure in the futures contract. So if I have a futures contract, I know I'm going to get it in the future, but what if there's some opportunity to take advantage of it during the life of the contract? Okay, well, if that's the case, okay, then I'm going to benefit by being short and having this commodity in my warehouse. All right. So it's this monetary benefit that comes from holding a physical commodity versus being long in the equivalent amount in a futures contract. Right. So there's option value if you want to think of it that way. So if we go to the next slide. I guess it's 2 slides from now. So what about this convenience yield? Well, the convenience yield, as it turns out, is going to be related to inventories. Okay? And inventories, of course, are related to storage. That's why we talked about that. But there's an inverse relationship between inventories and convenience yield. So if you're the only person with a warehouse full of wheat, okay, that means that the inventories are really low. Well, then, you know, that convenience yield may be really valuable because you'll be able to eat and keep your kids alive until the end of the contract, and by then, you know, it will have started raining and we'll all have wheat or whatever the story is you want to tell. So the lower the inventory, the higher the convenience yield. Stated equivalently, the higher the inventory, the lower the convenience yield. So what does that imply? Well, if we have high inventories, we have lower convenience yield. And if we have low convenience yield, we're going to have higher futures prices relative to spot prices. Why is that the case? So when we think of this, the equation, and we'll see it's written out in a prettier form in a little while, but what we could say is, look, the futures price has to be equal to the spot price today plus any interest cost. And we normally specify that as a %, okay, but I'm just going to put it in as dollars here. So the interest cost, that's going to increase the forward price. The higher interest rates are, the higher forward prices are. Okay, plus storage cost. A-G-E, I can spell storage. Cost. Okay, so the higher storage costs are, the higher the forward price. And then we're going to subtract off the convenience yield. All right? And all of these are specified in terms of dollars. Right? So if this is going to be, you know, $100 and the financing cost is going to be 10 and the storage cost is going to be 5 and the convenience yield is going to be 3, okay, well, then that's going to equal what, 112, right? 112. Okay, well, the higher the convenience yield, the lower, okay, the lower is going to be the forward price, right? So, so the higher the convenience yield, the lower the forward price, because it's going to be an offset here. So let's make sure that jives with what we said. The higher the inventories are, the lower the convenience yield. Yeah, so the lower the convenience yield, the higher forward prices are going to be, or the higher the convenience yield, the lower forward prices are going to be. So if you think of it, we could write it like this. The forward is equal to the spot, plus we could put in R for interest rate, or for interest cost, plus we use the variable U for storage cost in the curriculum, minus Y, which, well, that was terrible Y. So I'm going to try to save it here since this doesn't erase very well, which would be the convenience yield. Now we're going to write this differently, and you'll see it in a little while, but all we're doing is converting these to % terms, okay, and then putting it in continuous time. So, and I'll point it out when we get there. All right, so convenience yield, something you want to understand. The higher the convenience yield, the lower the forward price. Okay, and the lower the inventory levels, the higher the convenience yield is the way that works. So some relationships you want to keep straight there. So I'm going to say, write it up here for abbreviation. The higher the inventory, that's what I wanted to say. The higher the inventory levels, okay, then that's going to give us, okay, a lower convenience yield, right? So, and then the lower the convenience yield, that's going to give us higher forward prices, higher F. Okay, that makes sense? So two relationships you want to make sure you have a handle on there. And again, I apologize for all the chicken scratch. But anyway, so you okay with that? So a couple of things to keep in mind there as we go forward. Okay, asset superclasses, capital assets. These are, stocks, bonds, those types of things. You're going to value them with discounted cash flow. They're expected to produce these ongoing cash flows. There's also assets that are a store of value. They don't generate income. Okay, but and they can't be consumed, but nonetheless they represent a store of value. So currencies would be one, artwork would be one. I would actually put gold in this category as well because we don't really use it in our production processes anymore, but I think they put it somewhere else here. Then we also have this third category, and this is the one we're really worried about for this reading. That is CT assets, consumable or transferable assets. They don't generate cash flows generally. They have economic value because they are an input. Wheat is an input. Nobody eats wheat. They eat flour or, something that comes out of it. No one eats cattle. They get butchered and you have meat. Those types of things, right? So they're an input into production somewhere along the line. Nobody eats oil. They use it to transport the food that they have to have. So commodities are almost always CT assets. So wheat, oil, cattle, those would all be CT. Some people would put gold in here because gold is used as an input in some places, although it's certainly fading in the modern world. Anyway, so these would be CTs, and this is really what we're talking about here in terms of asset superclasses. So how do we invest in these CT assets? Well, we could do it by simply buying the good, right? So go out and buy yourself 1,000 head of cattle, and that's great. The problem with that is you got to store them, right? You got to store them, and you got to maintain them and all that sort of stuff, and that's just going to be a hassle. And if you're going to bring them into the backyard, you better have a really understanding spouse. Okay? You can also buy the stock of commodity producers. So go find a big wheat farmer or agricultural producer, buy stock. That would be one way to get some exposure to these underlying inputs into the production process in our economy. The problem there is you're buying the stock, and the stock is going to have low correlation with the value of the commodity. Now, the correlation is positive. The value of the commodity goes down, that pulls the stock down, and vice versa. Okay? But it's not going to be the correlation between a traditional asset investment and an investment in a commodity stock, okay, is going to be a lot higher than the correlation between a traditional asset investment and the value of the underlying commodity itself. Okay? So commodity mutual funds, these are actually things that are diversified, low transactions cost, and they're just generated so that you can get commodity exposure. These are people that usually manage them with futures, futures contracts or some type of derivative, but nonetheless they give you exposure to the underlying asset. Okay? But what we really want to talk about is using commodity futures to access this market. Okay? They are convenient, flexible, low transactions cost. Highly levered, meaning you don't have to put up much cash in order to trade them. The only trouble is that you have to continuously roll the maturing contract. So all forward contracts are going to have an expiration date. Okay, it can be longer or shorter. It can be 1 day. It can be 270 days. Okay, but eventually that contract is going to expire, and you're going to have to roll it over, and someone's got to worry about that. So it's not a passive strategy. It's not like, oh, I want exposure to gold, so I'm just going to buy a bunch of gold and keep it in my room, right? Here you're going to have to be cognizant of when the contract matures, and then you roll it over into a new contract. There's also structured products out there. There's exchange-traded funds that work off a commodity index. There's commodity index certificates, which are basically bonds that change the interest payments based on what happens to the commodity index. So there's a number of ways to gain access. Okay? The mutual fund thing, structured products are direct and easy. The actual investing in the underlying forward or futures contract is a very direct way to do it, and so it is it's easy enough, right? So you don't have to be a genius to trade a forward or futures contract. All right, so the forward price versus the spot price of a commodity. So I've been talking about this since the very first slide because I needed to talk about all those other things. But remember, I've already written this formula for you. I just did it in a different way. I started out by saying the forward price was equal to the spot price plus some dollar of interest plus some dollar amount of storage cost minus some dollar amount of convenience yield. Right? And then I changed and I said, now we could also do it in terms of percents. We could say, well, let's take the forward price, okay? And I'm not sure I wrote it like this, but this will be good. Let's take it, and the forward price can be equal to the spot price times 1 plus, okay, the interest rate, R, plus storage cost, stated as a percent of the value of the asset, minus a percent convenience yield y, right? So that would be if we did this in discrete time. So this could be, 10%, and this, I guess, 0.1, and this could be, 0.05, and this could be, minus 0.03, which would tell me that my total cost would be 12%. So high interest rate, okay, higher forward price, high storage cost, higher forward price, high convenience yield, lower forward price. So the convenience yield is an offset, right? So anyway, this is exactly the same thing. So this is simply saying let's equal to the spot rate times 1 plus this R, okay, plus U minus Y, where these things are all stated as percents, okay? And then you got to adjust for the amount of time. So this one's just in continuous time, right? So don't be afraid of the equation is what I'm telling you. In fact, don't worry about it. Just realize that the bigger this is, that's going to have some impact on the forward price, because that's really what we're going to talk about. So T is the amount of time, S is the spot price today, the forward price is what we are agreeing to buy or sell at in the future, and then we have interest rates, storage cost, and convenience yield all plugged in there as a way to calculate the forward price. Now, let's talk about the impact of this convenience yield, and this is, I think, getting to the heart of the reading here. Okay, so we can think of this as saying, look, if we have a spot price of $10 and we have an interest rate of 10%, so we're going to multiply that by 1 plus 0.1, and well, I'm just going to stop there. That means that the forward price is going to be $11, right? So normally, okay, we have a forward price that is greater than the spot price. That's what we mean down here when we talk about contango, right? The forward price is greater than the spot price. Okay? But on occasion, we end up like in a bond forward contract where there's interim cash flows, which would have the same impact as a convenience yield, and we end up with a forward price that is lower than the spot price. So when we look at the backwardation, I'm going to get rid of this for now. So we're going to say, well, what if the forward price were lower than the spot price? Okay, so the price today is $10, and you could actually lock in a forward contract at $9. Well, that probably means there's some interim cash flow. The point is, for both backwardation and contango, okay, we are looking at the forward price versus the current spot price. That brings us to an important issue, okay? And we need to make sure that we understand the difference between backwardation and normal backwardation. So normal backwardation is where we are looking at the relationship between the forward price and the expected future spot price. So the spot price and the forward price are both observed at the same point in time. So that would be time 0, right? And if we're looking at a timeline here, 0, and then the maturity of the contract is cap T, well, we can't observe it ever, right? But we know that there is this expected spot price in the future. So there's some expectation. It's not directly observable. So when we talk about backwardation or contango, we're talking about comparing two things that are observable today. The forward price that we can lock in today and the spot price today. Easy. Okay? When we talk about normal backwardation, we're talking about the forward price today and the expected future spot price. All right? So in what this gives us, okay, is we also would have normal contango. So, but normal backwardation is the one we want to talk about, since that's the phenomenon that we're trying to get to. What if markets are normally backwardized, right? And normally backwardized doesn't mean normally is happening all the time, but it's normal backwardation, and they're normally backwardized more than we would expect it to more than we would have expected, given some random fluctuation. So you can't tell what's going on with this on any one contract. But here's the point. Okay? If we look at forward prices, okay, that you can lock in today, they end up being less than the spot price at expiration too much of the time when we look at these commodity markets. So in other words, if we're looking at this through time, okay, and we're looking at dollars here, well, there's going to be some expected future spot over here, but we really don't know what it is. We can enter into a forward contract today. We'll say that's $9, right, equals 9. Well, when we get over here, what's the expected, what is the spot price going to be over here? What is S sub capital T going to be? Well, it might be that the actual spot price at maturity is, 11, or it might be 7, but that's because there's uncertainty in the price path of the underlying commodity, right? If we abstract from that, Okay, and I'm going to go to the next slide. If we abstract from that, let's just say for the moment, okay, that we have a spot price and an expected future spot that's constant. Okay? So any change in this expected spot price would be because of changes in the underlying value, and that would be what we're ultimately going to call a spot return. Okay? But the forward price, the spot price today is going to be equal to 10. And we're going to assume that we don't ever know this for sure, but the expected spot price in the future is going to be 10 as well. So we just think the price of wheat is going to be $10 a bushel going forward. I know there's lots of wheat farmers that would think that was great. That's real high for a bushel of wheat. Anyway, the point is this. Okay, if we have a market that's normally backwardized, what is required to have that? Okay, well, we're going to remember it's going to be the forward price is equal to the spot price plus interest plus storage minus this Y convenience yield. You got to have a big convenience yield to overcome the impact of interest and the impact of storage, so that if this is going to be 10, this ends up being 9. Right? So that would be a market that's normally backwardized. And why is that important? Well, if we have a forward price that we can enter into today at 9, okay, the spot price is 10, but we really don't care about that. What we care about is this expected future spot price over here. And I'm going to put this as the time. Right? And this is cap T for the contract. Well, what's going to happen? If we can enter into a contract today at 9 and the expected future spot is 10, okay, well, we go long in the contract. We're agreeing to buy at 9. When we get to the expiration of the contract, the underlying is worth 10, so we can buy at 9 and sell at 10, and we make a profit, right? Well, then we roll over and we do it again. So we roll over our contracts and we do it again, and then we do it again, and then we do it again. So a market that is normally backwardized is one where if we enter the contract today, then a big percentage of the time we end up making a profit. We enter a long contract today and we make a profit, okay, when we get to the expiration of the contract. And the point of what we're going through here, or you're going to have to read between the lines to see this, is that if you want to look at the total return on what's called a collateralized commodity futures contract, that means you're going to buy a T-bill equal to the forward price, or matures for the forward price at the same time as the forward contract expires. So you've collateralized this, so you know you have the cash there to buy the underlying commodity. So you take a T-bill that's got the value of the contract embedded in it, and then you go long in the commodity. Well, you're going to get some sort of spot return, right? So the price of wheat's going to go up or down a little bit through time based on whatever supply and demand function we're looking at. Okay, you're also going to have some collateral return because you own a T-bill, and you're going to get a rebalancing benefit, but I don't want you to worry about that here. But it's something you can only see if you look at it in the context of a portfolio. Okay, but then we have this roll return, right? And if the markets are backwardized, then the roll return ends up being positive. So this total return from this collateralized commodity future investment ends up being higher than one would have expected because we have this normal backwardation that occurs and gives us a positive roll yield. All right? So if we come back over here to normal backwardation, I apologize for all the chicken scratch, but nonetheless, this idea of normal backwardation, this is where the forward price, okay, and I'm going to get rid of this because I want to write out my the main thing that you need to know about normal backwardation. This is where the forward price is less than the expected future spot price. Okay? So if that's happening, that's normal backwardation. And if you're doing this commodity investing, right, so you're commodity futures investing, you end up making a profit every time you roll over these contracts, or at least a bigger percentage of the time than you should. So anyway, so that's the idea behind this normal backwardation, and the notion that we're going to be able to do this collateralized commodity futures. Well, we had I guess the underlying point the authors are really trying to make is people really like this collateralized commodity future strategy, and they're trying to talk about it as an asset class because they get a spot return, which probably is going to be close to zero over time, but they get a collateral return, right? That's whatever the return on the T-bill is. They get some benefit from diversification, in their portfolio, and then they get this positive roll yield. So if the market migrates from where it's normally backwardized to where it's not backwardized, not normally backwardized, people are going to be less enthusiastic about this. So spot return, that's just from the change in value of the underlying commodity. Collateral return, that's the return on the T-bill that we're using to collateralize all this. Okay, rebalancing, this is a diversification. There's lower correlation, so we reduce the variability of the portfolio. So whatever return we're earning, it looks better. Okay, but it's this roll yield that I want you to focus on. Okay, and the roll yield is positive if the market is normally backwardized. All right, be negative if it was in normal contango. So excess return versus total return. So total return we just is going to be our collateral return plus whatever happens on the futures contract. The excess return, that is above what we would expect from the treasury bill that we're collateralizing this with, is the spot return plus the roll return, and this is for a single contract. So we don't have to worry about this notion of down here at the bottom, a rebalancing return. All right? So excess versus total return. So roll return versus term structure. So if we've got new futures contracts are going to be less expensive than maturing contracts, okay, well then we're going to have a market that is normally backwardized, and we're going to end up with positive roll return. Okay, if we have normal contango, then we're going to have negative roll return, and that's going to change the way we feel about these collateralized commodity futures. Okay, and to wrap this up, let's think of expected returns. How do we calculate expected return on a futures contract or forward contract? Well, we could use the CAPM, except what? That's the C in CAPM stands for capital asset, right? Well, commodities are not, forward contracts are not capital assets. So since they're not capital assets, we can't use the capital asset pricing model. We could take an insurance perspective. Okay, that is a long commodity position is going to earn a positive risk premium. So you agree to buy, you take the long side of the contract. Well, we would expect hedgers, producers, to be the ones that are offsetting. So the speculators are going to earn a premium from the short hedgers. So why? Because they're providing price insurance. So that would be one way, and we could go in and use insurance theory to come up with the price or the expected return. Don't like that one too much. The theory of storage we talked about, you know, how storable is it going to impact inventory? Inventory is going to impact the forward price, and from there we can look at expected returns. But the one that makes sense in this context, or most sense to me, I guess to everybody, is the hedging pressure hypothesis, and that just simply says, look, we can have a lot of the hedgers be short, okay, which means you're going to have longs take the other side of the contract. So if all the hedgers are short, then the longs are going to have to be speculators. And the speculators aren't going to come in and say, well, if I enter into a forward contract, okay, to buy something at $10, and that's also equal to the expected future spot, okay, well, is a speculator going to take that deal? Well, if it works the way I think it is, I'm going to buy at 10 and sell at 10. No, that's not the speculator will not do that. So if the expected future spot is 10, okay, well, then we're going to have a forward contract that has a price lower than that to give the speculator some incentive to enter the contract. So the long is going to come in as the long, agree to buy at 9, expectation is 10. Yes, there's risk in that, but that's what they do because they're speculators and they live in New York. Anyway, we could have this the relationship between the forward and spot price. Well, if you have all of the natural positions on short, well, then you're going to have a market that's normally backwardized. If you had all the natural positions that are long, it'd be the opposite because the speculators would have to take the short side. Okay, and that would give us a market that was in normal contango, right? And I realize that you're probably thinking, wow, that's a lot of stuff to juggle. But just remember that there is an expected future spot price out there, right? S sub T. So there's an expected future spot price out there. It's not observable. We're not saying that we can observe this on a single contract. You've got to observe multiple contracts through time to be able to say, boy, that sure seems weird, right? But if we have a forward price equal to 9 and the expected future spot price is higher than that, well, you can get a positive return by taking a long position, right? So I'm going to agree to buy at 9. I think it's going to be a price of 10. Well, all right, so I can buy at 9, sell at 10. And if we reverse the relationship, so the forward price is 10, the expected future spot is 9, then you would earn the same return by taking the short position. So it's this hedging pressure hypothesis. Where are the hedgers? Are they predominantly long or are they predominantly short? If they're predominantly short, that's the farmers. There's going to be a normal backwardation. If they're primarily long, they are bakers, need to buy wheat, okay, then there's going to be normal contango. All right. So, well, what is it that we need to know? Well, of course, the idea of storability and renewability, there's something there. Okay, convenience yield versus inventory levels, I would make sure and understand that. Backwardation and contango, I would put a check mark by. But what I really think you want to know is normal backwardation. And I'm just going to put norm back, okay, because that's where backwardation and contango compare, the forward versus the spot. Over here, we're comparing the forward versus the expected future spot, right? Okay, so let's see, components of commodity return, so I would put a check mark by that. Roll return versus term structure, that is the idea, are all the hedgers short or all the hedgers long? And then the theory of commodity returns, in particular the storage theory and the price pressure hypothesis are the two that I would pay most attention to. So, like I say, interesting little reading, has this kind of twist that revolves around convenience yield and normal backwardation. A little harder to get your head around that, I realize, if you haven't looked at it before, but with a little bit of thinking and maybe a few notes, I think you're going to do fine on this particular reading.